This is the Keeping Your Money Show with Jamie Westenberger and Bart Steidler.
Welcome back to the Keeping Your Money Show. This is Jamie Westenberger, joined as always by Bart Steidler. We were just laughing because as we were coming back on the air, I was actually kind of forgetting what I usually say when we come back. Small
faux pas.
Brain bump there. So this is the Keeping Your Money Show where we cut through all the bulls, the booyahs, bells, whistles, honks, and horns to get you to the information that actually helps you move towards retirement. We've been talking about 4 common personal finance tips that will actually fail you. Is $1 million enough to retire? All that and more. If you're missing part of the show, you can always find it on our website. Just go to keepingyourmoney.com. You can also find it on all of our podcast partners, iTunes, Google Play Music, SoundCloud, YouTube, Stitcher, and Spotify. Just go to the Keeping Your Money Show. Bonds. You know, if you rode the wave in 2008, you found out how unpredictable any investment can be.
Right.
And I think so often we get this idea that there are certain types of investments that do not have risk to them, or we believe they're risk averse or they're less risky. And it's kind of a misnomer because really anything you put your money in has risk. If you put your money in an FDIC insured bank account that earns 1%, you still have risk. You have risk that inflation will outpace the interest rate that you're receiving. Therefore, your money becomes worth less a year later because you didn't keep up with what you actually needed to keep up with. I mean, even the safest thing in the world, you could bury your money in the backyard. You won't lose it, but it might not be worth what it was when you dug the hole, you know? So the idea of risk isn't just about losing 10% because of a trade battle between two countries or because bombs drop on somebody. It can be a lot of different things. And bonds, sometimes we ignore or we fail to see the risks that exist there because we don't think of them like we do equities.
A lot of portfolio managers say, yeah, the bonds are the safe part of your portfolio, or they reduce volatility in your portfolio. And sometimes they have worked that way in the past. It doesn't mean they necessarily are going to work that way in the future. One of the risks they talk about with is the fact that sometimes bonds default. And knowing that we were going to have this little conversation, I went on the internet and looked up, major bonds that have defaulted, and the list was huge.
Significant.
There's first of all, there's a ton of Puerto Rico bonds that have defaulted.
Greece.
And,
Enron.
I remember like 15, 20 years ago, every bond guy out there or bond person out there was saying, buy the Puerto Rico bonds. They're guaranteed. It's going to give you a triple tax credit. In other words, they were
touting triple tax credit like crazy.
Federal, state, and local tax. Mm-hmm. They would be tax free on all 3 levels. And people were like, oh yeah, I make this percentage and none of it's going to be taxed. So that's the equivalent of making a higher percentage. And now you look at the list of bonds that have defaulted, and there's hundreds and hundreds of Puerto Rico ones. Mm-hmm. You think, okay, I'm investing in a good area. Okay, I saw bonds that were defaulting in Houston, Texas, which is a very financially strong area.
Which doesn't mean anything else about bonds in Houston, Texas. It simply means whatever that issue was.
That particular one was for a sports authority, and they weren't able to generate the money to pay back the bonds. So, sure. Bingo, they had a problem there.
Well, the thing with credit risk, too, is, I think a lot of times consumers don't keep up on the lingo.
Right.
We have vernacular in our industry, and we have a great job of changing it regularly as soon as the common folk figure it out, right? So we all remember Mr. Milliken in the 80s with his junk bonds, Mm-hmm. If you went to the average person today and said, would you like to buy a junk bond? They would say, oh, no. But I bet if you look in your 401k right now, you have something called a high yield fund. And I'm gonna blow your mind, but guess what junk bonds are now called? They're called high yield because it sounds prettier. It still means they're a lower quality of credit that pays a higher interest rate. Now, that's not to say there's not a place for that in your portfolio. There very well may be, or there may be no place for it. But if I asked you if you thought you would own junk bonds and you said no, and then you open up your investments and you own anything that says high yield in it, guess what? That's what you own. Right. So even just acknowledging and understanding what you own in the bond space can be a huge advantage as well.
The amount of things that people don't know about bonds, they probably know a lot more about stocks because stocks are talked about a lot more. There's different investment products that people are a lot more familiar with. But by and large, I mean, there's a lot of differences in bonds. I mean, there's some bonds that are offered by municipalities. They're offered by, transportation boards. They're offered by corporations.
Well, and even municipalities. I mean, we go back to during the credit crisis, you might not want to own at the time a Detroit City bond. Okay.
Yeah.
But if you owned a bond, and I'm not recommending any of these because I'm just kind of speaking in generalized terms, right? But you might have owned a Wayne County airport bond, which was based on the parking structure and was paying its payments on time because people were still traveling and parking in the parking structure.
Right.
You might not want to own a Chicago general fund bond because they don't seem to have a really good grasp on their finances right now. But if there were one for Wrigley Field, which I think has sold out, I don't know how many hundreds of games in a row, that every ticket, $1 of that went to pay this bond, well, that might be considered a little safer of an investment, even though it's in the same area. It's a different type of bond, which makes a big difference in the risk of it.
Yeah, and not to get too technical, but a lot of the bonds that you mentioned that you said might be a good consideration, the revenue generated from those, like a parking structure,
right?
The revenue generated from that by law has to go towards paying down the bond.
Yep.
Whereas if it's a general obligation bond, it's just the general obligation of a governmental entity, which sometimes yes and sometimes no are good at taking care of those obligations.
So here's an interesting risk in bonds that I don't think people consider nearly enough, and that's the idea of reinvestment risk. And I'll give you an example. You might buy a high interest bond from what you consider to be a low risk issuer. Maybe it's a company that's a really strong company, but they've had a couple bad quarters and they needed to borrow some money, and you figured, hey, this is a no-brainer, right? Mm-hmm. The problem with that is the minute that company can get a better interest rate, they're gonna buy you up. They're gonna call that bond. So you might have this opportunity, and maybe you paid a premium. You paid over the actual value of the bond because this interest rate was very attractive to you. Yet 2 years into it, they call it, clearing out the bond, and you don't get all of the premium that you had paid to receive. There's a lot of intricacies to bonds. They're not just some cut and dry type of investment. The same goes with liquidity. If you own a stock portfolio and you decide tomorrow you don't want to be in that stock portfolio, if you own the types of stocks that most people own, you will be able to find a buyer for that on Monday morning. If you own bonds, many times bonds are much more thinly traded, meaning they're not being traded on a daily basis. You have to actually take them to a bond broker, which packages them and tries to sell them on the market to someone who wants to purchase those. So where that can really blow up in your face is, let's say you had one of those Puerto Rico bonds you were talking about. I will tell you right now, when people wanted to get out of those, there weren't a lot of people looking to buy them. And if they were buying them for pennies on the dollar because they looked at it as a high risk, potential long-term reward.
Right. You may be receiving $15 or $20 per $100 you invested on it.
Right. And then the last one is really inflation risk. Usually bonds are long-term investments. It takes a long time to receive your principal plus interest payments back. Many times the fluctuation of the value causes you want to hold it to term. And in doing so, if you average out what you returned on that versus what the inflation on your money was, many times the overall return on your investment really just wasn't that great.
So with bond rates being low right now, and I think is it the 10-year or the 30-year that's about 3 something?
The 10 years 3 and some change.
Okay, 10 years 3 and some change, which is relatively low.
Very low.
I mean, you don't want to tie up your money for 10 years to get a 3 and change % return.
With inflation running at 2 and some change, no, not really.
Yeah, so that's not really getting you anywhere. So what do? Well, you sit down and you have a conversation with your financial advisor, because there are alternatives to bonds that can mimic the characteristics that used to make bonds popular in a portfolio.
Well, and let's face it, there's ways to structure bond ownership that can take into some of these risks as well.
Right.
I think the real concern is when somebody just goes out, sees the bond fund in their 401k and says, well, that's where I'll put 40% of my money because that's safer.
Right.
That's not a for sure. There's a million things that go into deciding whether that really is safer or not.
Yeah,
And just because it has the word bond in it does not mean it's safer.
right.
And in many instances, depending on if it were high yield or something of that nature, it could actually be even less safe. It could be more aggressive. It could be more volatile.
During the recent period where interest rates were going down, before they bounced up a little bit, most lost value. Mm-hmm. And as interest rates go up, that tends to reverse itself as a general rule, not every time.
It's the opposite of that. That's what you meant.
Yes. So basically,
when
the
interest
values
rates
of bonds
go
are
up,
gonna-
values go down.
It's inverse of the
Right.
direction interest rates are going.
Right.
So,
I knew what you meant. I just wanted to make sure they knew what you meant.
right. And it's important that they know.
Which is important, though, because if we were to look at interest rates going forward, we're much more likely to be in a rising interest rate environment, even if we set over a 10-year period of time. And when we're at still historically low interest rates, it's very unlikely interest rates are going to retrench and go lower. So that being the case, the likelihood is bonds will probably lose some short-term value. Not a reason not to own them, but a reason to understand what you own so you understand how it will operate. Just another example of why sitting down with someone and actually discussing this type of stuff for you personally makes a lot more sense than simply doing well, I'm 60, so my portfolio should be 50-50 or something like that. Just not a great way to do investing, especially when we're 10 years into a very impressive bull market and you're probably 10 years closer to retirement. All right, we're coming up. We're going to talk about some apps that might help you with your personal finances right here on the Keeping Your Money Show.